Obviously, it's been really a year so far in 2022 when the market wants to play more defense than offense, at least in terms of the indexes. How do you sort out the influences on what the market's up to here as we, maybe look to test those late January lows in the S&P?
Yeah, certainly, Mike, and thanks for having me on Valentine's Day here. I think the market is facing what we are calling a dual headwind right now. We came into the year with not only a Fed that could be moving pretty aggressively, but also fiscal policy that is now waning. So for the first time in quite some time, markets are facing reduced policy support from both the fiscal and monetary front. And of course, how's that played out in markets? Well, certainly we've seen volatility across the board, but where we've really gotten hit is those higher valuation, more speculative asset classes that have sold off. But if we take a step back and, to Steve's point earlier, when we look at the fundamentals of the economy, this is still an economy that's probably going to grow above potential this year, 3 to 4%, probably an economy that's going to have earnings growth 8 to 9% range. And we're still looking at a consumer that's relatively healthy. Now, in the near term, we do think that the Fed will have to move pretty aggressively. So probably the March through July meetings, those 4 meetings are probably live meetings. But after that, as we head towards the second half of this year, we really do have to see if they have the opportunity to move more gradually because we're seeing a little bit of relief on the inflation front. Now, you talked about supply chain issues potentially easing. Labor supply may get a little better by that point. But we also have to look at the demand side of the equation. So if we have 4 to 5 rate hikes already in the system, does that slow demand? And so both sides of the demand and supply inflationary equation, can they get a little bit better so that the Fed can move at a more gradual pace going forward? We think that could be supportive of markets as well.
I guess the question from, for an investor at this point is the stock market, are there ways within the stock market to take advantage of the fact that maybe the underlying economy still is in pretty good shape? I mean, I guess a lot of people will remember that the stock market did awfully well from, early 2020 for the next year and a half when the economy was on, more wobbly footing. So, we getting payback here, or are there parts of the market that can capitalize on the real economy here?
Yeah, it's a great point. And look, historically, as you noted, the S&P has had positive returns over the last 5 Fed cycles through a Fed rate hiking cycle. And in fact, when you think about recessionary conditions where we really start to get concerned about, 20% plus bear markets, those don't tend to occur until on average 24 months after the Fed starts raising rates. So that's a 2-year kind of lead time you have there. To your point, we do look for how can you win on a relative basis in this backdrop with rising rates, inflationary pressure in the near term elevated. Well, what we really kind of go back to is what we called our core playbook from the beginning of this year. And that includes value cyclical names. Keep in mind areas like financials tend to do well as rates rise. Energy, industrials, all can do well. Especially if we get what we're calling a reopening 2.0, a mini reopening as the Omicron variant hopefully fades and we get into the spring and summer months and we see hopefully a global rebound in terms of travel, leisure, and those type of services-oriented activities. So value cyclical. We are also looking outside of the U.S., particularly towards the EM markets, which, by the way, are up year to date. And, we think those are less exposed to some of those higher valuation tech sectors as well. And then finally, as we get later in the cycle, we would round that portfolio out with a little bit of defensive characteristics. And that includes parts of tech, but particularly the better valuation, higher quality tech, and also perhaps areas like staples and healthcare. But in the near term, we continue to favor value cyclical and non-U.S. Here as we head towards that Fed meeting.